Let's talk about fixed income or bonds in a bit more detail. So going to the first slide, it's easy to assume that bonds function as good diversifiers in portfolios, and indeed it's true in many respects. We've often talked about the need to have a good mix of asset classes in portfolios for diversification reasons, and bonds are an important component of this. But, and it's a big but here, not all bonds are the same. So let's take a minute to refresh ourselves. You can split fixed income or bonds into two categories. Now, if you look at the slide on the left, the first category are the so-called safe haven government bonds, which includes US Treasuries, German bonds, Japanese JGBs, and UK gilts. Now, these are issued by the so-called safe haven countries, and these are bonds that are perceived to be the highest quality instruments. And then if you look on the other side of the slide, on the right-hand side, you've got credit. And credit basically covers everything other than safe haven bonds, and these can include less credit-worthy countries. So for example, high-yield bonds issued by emerging market countries. And of course, bonds issued by companies are the most well-known form of credit. You've got investment-grade corporate bonds issued by more credit-worthy companies, and then you've got high-yield bonds issued by less credit-worthy ones. Now, here's the thing to remember. The higher the perceived quality of the bond, the lower the yield, and vice versa. And this is why the yield on US Treasuries, for example, is a lot lower than the yields on high-yield bonds, for example, especially when things are volatile. So let's go to the next slide. This slide here basically looks at how safe haven bonds have performed next to equities this year. Now, if you look at all the bars on the left. These are all negative. These bars are pretty much all equity markets which have sold off significantly. Now, the few bars on the right that are positive are basically the government bonds that investors perceive as safe havens. Now, unsurprisingly, you have the ones that I mentioned earlier, German bonds, UK gilts, and of course US Treasuries, which is actually the top performer year to date. So let's go to the next slide. And I'm showing here the performance of the different bond sub-asset classes in just a little bit more detail. Now, as you can see, the different bond groupings have broadly performed as expected during the crisis. Safe haven government bonds are positive, and all of the other bond asset classes, the one on the right-hand side, the perceived riskier ones, they're now negative for the year, again exemplifying the volatility that we're seeing in markets at the moment. If you go to the next slide, which focuses on higher risk bonds, this slide shows the yield spread of the higher risk bond asset classes. Now, what is the yield spread? The yield spread is an indicator of the risk in these kinds of bonds. It's basically the excess yield that an investor can achieve over US government bonds. So if you will, it's the extra reward that you get for investing in higher risk instruments. So typically, the higher the reward, the higher the perceived risk of these bonds. So during crisis periods like now, you typically see these spreads explode upwards. For example, during the 2008 financial crisis, you saw this big spike. And during the current one, during the current crisis, we actually have seen another spike, as you can see on this slide. Now, the question is, how does this current spike compare with what we saw in 2008? So let's go to the next slide, which compares these spreads side by side, now versus 2008. And the answer is we're not at the same level seen in '08, but there is definitely stress in the system, and investors are definitely more fearful of riskier fixed income. But unlike in '08, we're not seeing the stresses caused by the almost collapse of the financial system at that time. Now, if you remember, at that time, the financial system was actually the cause of the problems that everyone saw. It's not the case today. For corporate bonds, particularly in high yield, today's risks basically come from uncertainty around the profitability of these companies because of the coronavirus. Demand has disappeared for a lot of these companies, and in some cases, it's up in the air on whether these companies will even survive. Now, a good example of this are actually airline companies, unfortunately. Hence, investors are demanding higher yields on their investments to compensate for these risks. So for example, take a look, check out the double-digit yields that investors are asking for in high yield or emerging market US dollar debt. And don't forget, some sectors like the energy sector are also facing challenges because of record low oil prices at the moment, just to complicate things a bit more. Let's go to the next slide. The next slide shows that even so-called safe haven asset classes have not been spared. Now, we know that equity volatility has spiked, that's obvious, but volatility of safe havens like US Treasuries have actually also increased recently. During periods of extreme volatility, investors sometimes look for any asset class to sell if they need to pay for something else. So, for example, if they get a margin call on some of their other investments and they need to top up with cash. And in the case of US Treasuries, which were sitting on significant profits for the year, it is tempting to sell and pocket the gains. And this is what happened earlier this year. We saw a similar phenomenon with gold, for example, which up to recently had risen significantly, and then it sold off. So basically, in times of extreme stress, it is possible that even traditional safe havens may suffer a blip. Now, despite recent setbacks, we still believe that safe haven government bonds will continue to act as good diversifiers within portfolios. We believe that the recent events I described earlier, they were a one-off as opposed to a trend that we will see continue. So let's go to the next slide. What do we think about fixed income going forward? Now, on core government bonds, the so-called safe havens, we remain underweight this asset class. And this is because yields are just so unattractive. For example, the yield on the 10-year US Treasury bond is way below 1%. This means that the returns on this investment is far less than inflation rates. But there is still a place for these instruments in portfolios as part of a high-quality bond allocation. We discussed this earlier. On investment-grade corporate bonds, we have recently upgraded them to neutral from underweight for the next 3 months. This is a tactical view driven by the fact that yields are now slightly more attractive. On high yield, and this is interesting, we actually think that the returns on offer for the long term are now getting attractive. We've discussed how you can even get double-digit yields on them. But, and there is a but here, during volatile times, liquidity in these instruments is challenging. And this means that the price you see being advertised isn't actually the price that you may get when you transact. And for this reason, we're advocating taking a much more cautious stance over the short term in the next 3 months. So we're neutral on a 3-month basis, but there will likely be a time soon when investors should overweight this asset class when things start to return to normal and liquidity returns. Our preference as ever is to seek out the higher quality of high yield. This reduces the risk that you see in some of these lower quality companies defaulting on their debt. And in this environment, you really want to seek out quality companies because there is every possibility that some of these weaker companies will just struggle to stay alive. And finally, I want to talk about Asia for a little bit, Asian fixed income. For Asian corporate bonds, you'll note that this asset class has held up relatively well this year, being only down slightly for the year. Within the corporate bond universe, we prefer Asia because they have slightly better yields on offer compared to their Western counterparts. Now, for Asian high yield, we think that investors are getting compensated now for the risks involved with this asset class. In the high yield universe, we prefer Asia because of the favorable policy options available to these countries. They've got more ammunition to manage the economic challenges ahead. And also there is a chance that Asia will come out of the current crisis before the rest of the world, as they started dealing with the coronavirus a few months earlier. Hence our preference for Asian assets in general.